Well, hi there, and welcome to another episode of Beyond the Code, where we focus on bringing you no fluff, actionable value creation insights from real operators in the field. We have another very interesting episode today where another traditional industry is being disrupted by two folks who are part of the old system and now see a technology first path forward to unlock a lot of value. We're focused on the commercial insurance space today, and the company in focus is Artio. Now, Artio is reimagining how insurance is bought and sold, starting with commercial real estate, but they have a lot more planned, as you'll hear on the episode. Over the past decade, insurance prices have skyrocketed while policies cover less and less. Now, Artio has addressed this problem by giving clients the analytical tools to understand the risks that are emanating from their businesses. They also help them understand the cost of insuring those risks and alternative methods that can save clients a lot of money relative to the traditional insurance market. They're basically providing very granular underwriting of every asset in a client's portfolio. And in order to do that efficiently, they're adopting technology in a variety of novel ways, disrupting legacy ways of doing things in the process. Very, very excited because we're joined by the two founders of Artio, Roberto and TC. Quick intros on both of them. Roberto spent his career in insurance, first as an attorney and most recently leading the alternative risk transfer team at a global commercial broker. TC spent his career mostly in PE and VC, investing in a lot of operating companies, always with a technology angle, including the traditional and insurtech company space. Roberto and TC met a few years ago when TC was looking for a sharp operator to partner with to disrupt the commercial insurance space and a lot more beyond that as well. And that's how their relationship began, and that was the birth of Artio. TC, Roberto, welcome. Where do we find you today?
Thanks for having us.
I'm in Denver, Roberto.
I'm in Monterey. Thanks for having us, Ani.
Lovely to have both of you on. Weather good, everything bright and sunny. I'm dialing from freezing cold New York, where we just have a pile of ice.
The weather's too good in Denver. You guys need to send us some of your snow and cold. We're in desperate need of it.
I'm going to say that the weather here in Monterey is boring because it's 65 and sunny every day of
Oh
the
my
year.
God.
So, can't complain. Can't complain.
I feel for you, Roberto. Thanks for rubbing it in. But wonderful. Let's get started because it is a complex value chain, and so I want to start before we understand RTO and understand all the unique things y'all are doing with technology on unpacking what the insurance and the commercial insurance value chain more specifically is for our viewers. So, Roberto, if you don't mind, just outlining, what the value chain looks like, who the players are, and a bit in terms of the flow of money and kind of risk ownership. And then we can unpack where Artio fits in after that.
Of course. Insurance is a group of transactions that allows our clients to transfer risk, meaning take their operational risks and have them live in somebody else's balance sheet, right? So in effect, you pay some premiums, and that in return for those premiums, you get the promise of future payments from an established company. And that in turn goes into a series of transactions from a retail insurer that we might all recognize to a reinsurance company. A reinsurer is an insurance company for an insurance company, and up the chain until ultimately you get to the nameless, faceless risk capital pool. Risk capital is let's call it a commodity looking to invest in different asset classes. And for us, it's insurance. So when we look at the transaction, there are a series of intermediaries, a series of balance sheets that are taking on risk. And the longer that chain is, the more pressure on premiums exists.
Mm-hmm.
We're taking a little bit of a novel approach, which is trying to collapse that value chain into its shortest possible form, basically putting clients and risk capital as close together as possible. And that is a technically complex challenge, right? That we're trying
Hmm.
to address.
Makes a ton of sense. And where would you say, you started to allude to this, but where does Artio fit in this value chain? And if you could outline, who would your clients be in this, who would your partners be in this, and which intermediaries would you be disrupting?
We are in the value chain. We have a couple of roles. Our primary role, we really translate a message. We help the two parties understand each other that traditionally is very difficult for them to speak the same language. Capital and insurance has a very high bar of entry, right? Actuarial
Hmm.
science, data fidelity, complicated math, right? We go into a discussion about a thing called tail value. So we try to
Hmm.
quantify what these extreme events might look like on a balance sheet. And that's not a common language for a retail client that's not in insurance. So
Hmm.
Ardio's primary role there is exactly that, translating a client's information, i.e., we make an underwriting platform for our clients that allows us to transact directly with these different capital sources. That's the first step, or the primary role for Artio. Additionally, Artio is also, let's call it the implementation and management of these structures, right? We help our clients manage the ecosystem around these insurance transactions, which happens to be very complex. So think from a claims perspective or an actuarial perspective or a cash management perspective or legal perspective. Our clients are in real estate today. They're excellent practitioners at that business, but not necessarily have the tools or internal resources to manage an insurance structure for commercial real for insurance, and that's where we support. I don't know, TC, do you have any further feedback in there? Any over the top for us?
Yeah, I mean, I think there's a lot to say. So when you look at the value chain of a traditional insurance policy,
Hmm.
between the insured and risk capital, there may be seven intermediaries, and to be honest, six of them can't really impact your pricing. It's just that the industry has evolved, over decades, over 100 years, right? Insurance is super old, and it's evolved in this horizontal way, which for a long time allowed the industry to maximally efficiently deliver a similar product to a lot of different clients, right? That's why there's not so
Hmm.
much choice in insurance.
Hmm.
And that bargain was a good bargain when insurance was pretty cheap and it covered most, if not all, of the asset that you were trying to insure, right? As soon as that bargain started to break, right? So like insurance started to get really expensive, and it started to cover less. All of a sudden, it's now not a great bargain,
Hmm.
right? And it's almost as if the industry has said, we recognize it's not a great bargain, but we're not going to give you more options. You still have to buy the same product, and sorry, it just is the way that it is. I guess like our fundamental conceit is we allow the client a very easy path into exploring all of the options that they actually do have, right? So like if we took the commercial real estate analogy, for example, commercial real estate, everybody pretty much understands that it's a lot about capital structuring. So you'll have senior debt, you'll have mezz debt, you'll have pref equity, you may have common equity, you may have low income housing tax credits. And really, based on the market conditions, the owner operator of a commercial real estate company is looking at all those different parts of the capital stack, and they're arbitraging them all the time. Like
Hmm.
sometimes senior debt is cheap, and the loan to value is high, right? So you take on more senior debt. Other times it's not. So you got to fill that sort of part of your capital stack with some other type of capital. That's sort of fundamentally what we're doing is we're exposing clients to more competition in terms of the capital that is going to be insuring their risk. And in real time, we're telling them, okay, based on the market conditions today, here's how much of each source we think you should optimize for. And if you do that, you can save 30 to 40% on your current premiums, often while arriving at a much better structure from an insurance perspective.
If I had to simplify this, and please correct me if I'm wrong, the entity providing the capital, all the financial institutions, traditionally did not talk to the entities, in this case, your commercial real estate players, paying the premium. And you're reducing that friction. You're providing a lot more visibility and options, obviously, through your platform.
Yeah.
Would that be an oversimplified way of articulating it, or anything I missed there?
No, that's definitely an issue. And I think it also leads to another good point, which is your insurance strategy should reflect your operating strategy, right? Like inevitably, insurance and the need for insurance and the need for risk transfer is created by your operating strategy, if you will, right? And too often today, or most typically today, the person in charge of buying insurance sits in one side of the house, and the person in charge of maintaining the physical properties or maintaining the operating strategy sits somewhere else, and they don't talk to each other. But in reality, that's a conversation that should be happening very dynamically all of the time, right? Because one influences the other. And that's another, not only are we bridging the gap that exists between risk capital and the buyers of insurance, but we're also bridging the internal gap that exists between the person in charge of procuring insurance and strategizing there, and then the people in charge of asset management or property management, or really maintaining the profitability of the business.
Which brings me to another fundamental concept, TC. If you could unpack risk for our audience a little bit. In preparation for this call, you were describing two buckets of retained risk and transferred risk. If you could walk us through what that means with a simple example, it would be very helpful.
Yeah, it's a good question, and this was actually like one of my original motivations for digging more into this, because while it's true that premiums have gone up considerably, pretty much, for all categories of insurance, whether it's homeowners insurance or commercial property insurance or general liability insurance, premiums have typically gone up considerably over the last decade plus. And that is a problem. But prior to this, I was running a prop tech investing platform associated with a multifamily company, an apartments business in California. And what I started to think about a lot more than the premium was the fact that, our retained exposure was getting significantly larger than it was 10 years ago. And what creates a retained exposure, right? You think about insurance, you think I buy insurance and now I've offloaded all of the risk associated with my balance sheet to the insurance company. That's not true, right? If you have a deductible, if you have a copay, if you have exclusions, if you have limits that are lower than the asset value, that all means you are retaining risk, right? And typically people are not quantifying the value of that retained risk. And so what I started to think about is, all right, leaving aside the premium growth, what are we going to do with data to help insurance buyers better understand the value of their retained risk, right? Or the potential expense of their retained risk, and what they could do about it? Because the insurance industry doesn't really go that far. They kind of stop at the water's edge of, the information that they need to underwrite you for a policy, but they don't really go further into, all right, how are we going to manage the risks that you're not transferring? And that was one of my original motivations. So like transferred risks are the things that are insured, and retained risks are sort of what's left over.
Got it. Okay. I guess then maybe to land that point home for our audience, Roberto, is it fair to say that, insurance is truly efficient in unexpected loss, like a building burning down, for example, but inefficient right now for covering any expected or probable costs, as TC was just articulating, and that's what we're solving for.
I think that's a great point. If you're expecting something to happen, right, and I expect you to pay for it, you're going to have to hire people, you're going to have to do work, and you're going to have to cover your overhead and profit, and therefore some frictional costs, right? Those frictional costs could be material. The idea is that you're going to try to retain as much of your expected loss as possible to eliminate those frictional costs, right? And that's nothing novel. The insurance industry has done that traditionally through the use of deductibles and retentions. The novel part about what we're doing and kind of landing at home, double clicking on the operational risk perspective, is the insurer's interests are in the transferred risk, the risks that reside on their balance sheet.
Mm-hmm.
We're actually focused on the efficiency of the insurance, not only on the transferred risk, right, which is the things that are living in the insurance company's balance sheet, but also on our operational side. We're also taking care of what's happening financially on our balance sheet, associated with exclusions and deductibles and how things move over time. And the combination of the two makes a more efficient transaction, right? So that's kind of the goal there, is to manage our risk effectively. And this is going to be like the first time we say this on this call, over multiple lines, over multiple years. So to TC's point, we're trying to match the risk finance function, right? The insurance purchase and the risk retention with our operational needs over time. And I think that's an interesting proposition and a hard challenge to tackle.
Just to piggyback on that, I mean, like let's think about that one a little bit more, right? With insurance, you have to renew the contract every year, right? So like, and that's about as far out as you can go. So the insurance industry, as it currently exists today, basically gets to retrade you on the deal every year, and they have all the information, and you have basically none, right? So like, guess who wins that retrade every time? The insurance industry does.
Yeah.
But also because of the fiction of that structure, right? When the big dollar losses are these catastrophic losses, right? Like the building burns down, a hurricane comes, there's a nuclear verdict with a general liability claim, and the odds of that happening in any given year are extremely low for most properties, right? For most assets. But when you price the insurance on an annual basis, right, the insurance company has to capture some material value of that probability within this totally artificially confined time frame, right? So you end up paying a lot, not only for the sort of expected losses, but you pay a lot more than you otherwise should for the truly catastrophic coverage, right? Because the insurance industry has created this sort of like 1 year time frame where they have to be able to recover that money in your premium. So another thing that we do is we say the time period is sort of artificial, right? And if we had more time, we could use time to our benefit. And if we had the ability to marry, a property loss with a liability loss, those are very uncorrelated assets or very uncorrelated liabilities. And so they sort of offset each other. We can use the same funding stream to cover both, right? So there's a bit of portfolio theory in there. For anybody who's built an investment portfolio, you know what we're talking about. Like you get some benefit from diversification, and in our case, the benefit from that diversification is we can fund less, which means it costs the customer less, right? At the end of the day, this is all about doing what's best for the client in a host of ways. And one of the most meaningful things that we can do is reduce their absolute spend on this category.
You answered a couple of follow-ups that I had there, but what we've understood is you've gained a lot of traction over the past, since you've started, right? Very early, 6 months in, 7 months in. Can you unpack a little bit in terms of the value unlocks that you hypothesized, and then what's really resonating with your clients? Because you are exposing them to retail, reinsurance, alternative capitals. Where are these value pools that they're really seeing that's given you such tremendous traction?
I'll take the first shot at it, but so we have gotten a lot of traction, and I think that speaks to two things. One is we are a technology company, but at the end of the day, the product that we are selling is not technology in and of itself, right? The product that we're selling is a better risk transfer experience. It's a better risk transfer, risk retention, risk management experience, right? And in very simple terms, it's saving clients money. So one, we have a product to sell. We're selling an existing product. But two, I think it speaks to just the desperation the market has for better solutions here, right? So we're focused on commercial real estate first because these are typically companies with a lot of assets that need to be insured, high dollar values, experiencing a lot of pain. When Roberto and I first got together on this, and I know we're going to get to the technology story here shortly, we both, he didn't need to agree because he already knew he'd been selling a version of this product for a decade plus. But it was pretty easy to convince me, a novice, right, that this was a better way to do this, right? In any market cycle, this is a better way to do this. If you were buying insurance, you would always rather have your own actuarial analysis to support how much insurance should I buy? And is the insurance I'm being offered worth it, right? Like we'd always rather start from that as opposed to just reflexively buying the insurance because we have to. So it took him no time at all to convince me of that. When we started to think about the amount of education required to go from buying this product to actually thinking about how risk finance works, and then beyond that, what are the tools that you can utilize to create the best possible outcome? We quickly, Roberto already knew this through experience, but I was like, man, that's going to be a tough sales cycle. It's going to be a tough sales cycle, and there's so many problems with it. I think what we've been surprised with, and again, I think this speaks to the just the need for better solutions out there, is what we thought was like a somewhat intractable problem before we had the technology platform built has actually been we've been able to overcome it. And we've gotten a lot more early client traction than even we expected without having the technology available to us that we have now. So that's been a pleasant surprise.
Makes a ton. Go ahead, Roberto.
One comment on that. I think the from my perspective, the key unlock is that we're for the first time talking to a client in terms they understand, right? So you buy insurance, you get a piece of paper, a policy, it's a contract, and it has a number, it's premium, and you're like, I don't know what that means, right? I made a check, I don't know what it means. For the first time, when we could talk to a client or a prospect, we're actually explaining in great detail what that means. And I think that's resonated heavily with our clients even before the actual tool.
Thank you for walking us through that context. It's clear in terms of the business model you're building, where you're building new things and you're trying to disintermediate the space. But underlying a lot of this, of course, is, I'm sure, a lot of data and tech moats. And you found some interesting areas to combine data sources. So maybe as a start, TC, what unique data sets do you think your clients currently have? Where does that live today, and what are some unique data assets that you're leveraging?
Yeah. So when you think about a traditional insurance purchase, right? Like your broker most typically is going to ask you for basically three sets of data. One's going to be called the statement of values, which is a industry standard term, and it's basically a spreadsheet that says these are my assets and here are 10 to 12 variables on any given asset that we use to underwrite. And then they'll ask you for your loss history, which is either going to be an Excel spreadsheet or PDFs, going back a number of years, saying here's how many claims we had for every exposure type and the value of the claim and the status of the claim. And that's basically it. That's essentially all that the insurance industry asks of a typical client. Right. So they don't ask you what is really your business model and what are your strategic goals over the next 3 to 5 years? And do you have any supporting information? Right. So like when I look at a commercial real estate company, by comparison, right, we get a full blown third party property conditions assessment for every property that we think about acquiring, which is like completely rich and all of this data. We obviously have all of our operating and financial data. So like, what is the data that exists that's relevant to risk that the insurance industry is not capturing? One example of that is the largest cause of property loss, insured property loss, is not hurricanes or fires or earthquakes or floods. It's water leaks,
Mm.
leaky
Yeah.
water pipes, right? Because you
Yeah.
get a bad leak in an apartment building, it drips down 3 floors. You got to rip out the drywall. You got to vacate the unit. It's a hugely expensive cause of loss, and the only thing that separates that event that lives in a loss run is that it was sufficiently large to be a claim.
Mm-hmm. Mm-hmm.
However, there are like 1,000 of these events that live in the repairs and maintenance part of someone's general ledger, right? When we look into that, whenever we see a plumber called on site, right, it's probably for one of a limited number of scenarios, most of which are leaky pipes, right, or leaky valves, leaky toilets, leaky sinks. All these things that are the precursor to the claim that are just they're not showing up to the insurance industry, frankly, because the industry is not asking for them. Now we can go get all that information and more, right? I think the list is very long, but we can go get all that information and more, and we can use it in a variety of ways. One, from an actuarial perspective, it gives us a much more robust data set to project the future with.
Mm-hmm.
Two, from an operational perspective, when you think about, man, where should I set my deductible? Or should I agree to this exclusion? And those are two things that you can sort of levers that you can pull to affect your premium. And right now, people are basically saying, I don't know, but I just want a lower premium. So I'm going to go with that really high deductible. Well, if we know that that property is experiencing $100,000 of water leak related events that are just captured in your R&M, now that's additional information that you can use to solve that problem or to align your insurance with your need. I'm rambling here, but I'll give you one example. Roberto's going to laugh because I always give this example. But in a prior life, we invested in a water leak detection company. Water leak detection technology has been around since the 1980s. I was asking the company in the course of diligence, what's your biggest problem? And they're like, man, the sales cycle is really hard. And I was like, well, give me an example. And they told me they went to one of the largest multifamily owners in the country, and they asked them, how much are you losing directly, not insured, not in the form of claims? How much are you losing directly every year due to water leaks? It took that company, I think, 6 to 9 months to collate their own data, and they realized that they were spending millions of dollars a year in basically self-insured water leak remediation. And guess what they did? They deployed leak detection technology throughout the entire portfolio. So I think there's a lot of low-hanging fruit here is the point. And there's use cases both to improve the insurance experience, but also improve the operating experience as well.
Such a richness of like operational data that exists, and when it's explained so clearly, the next question is, why hasn't anybody done this before? Why didn't people think of this? Marrying this operational data with risk and insurance data, because you're right, you can make it so much more bespoke. Yeah.
I think there's two technical challenges.
Yeah.
One, the retail insurer is developing a product for their needs, right? A retail insurance is selling a product that fulfills what they're trying to accomplish, which is, right, profitable insurance business. Not necessarily address the operational risks for a client on a whole. And to TC's point, these are small nuisance claims. An insurance company is not going to be effective at managing those, kind of what I mentioned before, associated with the frictional costs of managing expected claims. So they've never focused on it. On the other hand, a client has never had a direct incentive to manage those claims from a risk finance perspective. What do I mean by that? They have this, and I'm going to steal TC's language here because he uses it. They have all this information in the proverbial dusty file cabinet, but they don't know what to use. What's the value of using and analyzing that data, because it doesn't have a direct relationship to how much their premiums cost. So that has been kind of a little bit of a eureka moment, right, for us as we've developed this, which is we can actually use this data to directly inform how premiums are built up or what the proper premium should be. And that is Artio. It's the marrying of that non-standard, really good, valuable data to address our clients' operational risk, not only the finance function, right? It's this very rich world that we're living in. And we're just dusting off the files from the cabinet, right? We're using them for the first time. It's really cool, I actually think. So
the insurance industry's ability to care about this rich data that is available that they're not using is constrained by their model. Okay, like most of the insurance industry that we interact with are really 100% focused on selling annual insurance contracts that are, to Roberto's point, created by a retail insurance company. And those types of policies are meant to, not be windfalls for anybody, but they're meant to be high velocity, high churn policies, huge volume. Okay. And they're constrained by a year. So if the only sort of like lever you can pull to incentivize a client to do something is by giving them a discount on their premium, there's not a lot of money there, right? Like, so if you said, I'm going to give you a 20% reduction on your premium for one property, man, if that property's paying a lot, maybe you've given them $20,000, right?
Makes sense.
There's not a lot of money there. And then compared to what we do, where when we take over so much of the primary layer of insurance, we create millions of dollars of potential underwriting surplus that now the client owns. And so the financial impact of them taking preventative action to get ahead of losses that may develop in the future, the reward for that is so much greater in our structures than in a traditional insurance policy.
Makes a ton of sense. And question for either of you, am I thinking about this correctly in terms of you are also creating new derived proprietary data sets? So by combining these two, onboarding clients, running actuarial models, you're creating a lot more, a whole derived proprietary data set that has a lot more value. Am I thinking about it the right way, or?
I'll take the first shot at it. Yes, I think you're thinking about it the right way. I mean, I think we're all thinking about this question a lot with what's happening with the development of technology today, right? And I think one of the answers here is that while the data, like any given data set that we're sourcing is not proprietary, right? So like industry standard data on insurance or SOVs, loss runs. I mean, these are all similar versions of the same data. Property management software, property conditions. I mean, the list goes on and on. I don't think any of those data sets, in and of themselves are proprietary. The combination, though, of them is, and the data science that you can run on them is. So I think there's two main elements of that for us. One is as we grow and we get more traction and we have more clients, we are building our own book in the insurance industry, in insurance industry parlance, by which we mean, we are both transacting with clients and we're watching what happens with clients over time in specific industries, in specific geographies, and that is proprietary. But I think the really proprietary thing that we're doing is because we're marrying these data sets that have never been married before for specific purposes that we know are going to have value. Now, all of a sudden, we have a proprietary combination of a data set, and we could be running data science and are running data science on these data sets on an ongoing basis to improve everything about that we do. And really the only way to do that is if you have access to all of it. And you have to you can't just ask people to give you their data. You have to provide them something of value in order for them to do that. And obviously that's what we're doing.
One thing to double click, because I was to be clear, our clients' particular information is proprietary for them. It's unique and we don't share that at all. Just want to make that clear. It's the derivatives, right? The
Yes.
high math on it that is proprietary and unique. Their particular data is protected, and it's their, let's call it their fingerprint, right?
Yep.
Like this is my location with my address and so forth, right? So just want to make sure that we're not.
Good point. We don't want to scare anyone.
Absolutely. Yeah. No. Great clarification point.
Yeah.
You're essentially putting an actuary in your client's pockets. The question then becomes, how do they leverage these newfound actuarial insights that they now own, right? That they previously didn't own. And now they have these superpowers in their pockets. And how are you thinking about it in terms of your platform, the workflow, and enabling them to almost self-serve, I guess, or get the most from it?
Wait, let me take this first shot at it, TC. From my perspective, having the actuary, we could call it, in your pocket, gives you a bigger set of decision points you can make, levers you can pull. Normally, you can pull maybe one or two levers in a traditional transaction. Now you have 4 or 5 or 10 levers you can pull. So you're able to, let's call it, personalize or dovetail this newfound product to your actual operations. And that's the insight. And more importantly, those levers you can pull, those decision points you can make, are translated into the language that you could actually transact. For example, if you have an actuary gives you an exceedance probability curve and tells you that the values at risk are X and gives you some standard deviation and some statistical terms, you might not know how that applies to your business. Artio tells you, obviously there's the backup to it, but tells you, based on your information, this is actually what you can do, this thing or that thing. And that's really important, right? Having that level of granular information summarized and provided in a way that you can make a decision on, I think it's really powerful. TC?
I agree with all that, and what I would add is, like, and this is maybe less about the actual decision itself and more about how you arrive at the decision. But I think, from if you're thinking of it from the perspective of someone buying anything, right? You'd always rather know the price of that thing and the comparative value of that thing before you have to buy it, right? It doesn't matter if it's like a hot dog or a car or whatever. I think that the situations consumers find most frustrating or when they feel like getting a clear idea of value is almost impossible before they're forced to, execute the transaction. I think it's why, used car salesmen are the butt of every joke. But when I think about it in our context, basically what we've done is we've taken a process where it used to take 9 months to a year just to have the actuarial analysis of your portfolio.
Wow.
To the point where you could think about whether there's enough value here to pursue this relatively complicated transaction. And we've taken 9 months to a year, and we've basically made it instantaneous. Not quite instantaneous,
Wow.
but we're working on it. And what that does is now all of a sudden, instead of having to get wine and dined by a broker and basically marry them before they've bought a policy for you, right? Now we're flipping it. We're saying, let's give you the financial information first, and let's empower you, the buyer, the consumer here, to choose the best path for you, right? And that's a pretty powerful flipping of the normal convention in our space. And technology allows us to do that. I think a big story here is that 3 or 4 years ago, this would have made less sense, right? This would have had less scalability, but because of the tools that we have available to us today and how rapidly they're improving, we can put this information in front of the client in a way that they can make sense of to make the best decisions really quickly. And you'd always rather do that.
Are there any challenges on ingesting the data, getting access to the data? I believe property management platforms are like wall gardens. Any challenges there?
Um, I don't think there's any major challenges. I mean, I think the property management softwares that um, are at their foundational level, the accounting systems that most commercial real estate companies use to, essentially run their operations, right?
Hmm.
Run their financials, run their operations. Um, those can be challenging at times to deeply integrate with. And luckily, we're not having to start there. I think there are, other strategies that are available to us. But for the most part, most of this data that we're going after sits in your Microsoft storage system. It's your
Okay.
sort of sits in whatever the company's using to store their files, right? And so most of what we're using, most of what we need, it relies on either an upload from the client directly or send it over via email, and we'll do it on your behalf.
Perfect. Okay, so they've exposed all that data to you. They're not
Mhm.
blocking that off. That makes sense. Is there a huge variance in terms of data quality you get from clients and how that feeds into your model? Like some may be more sophisticated, some have very minimal data, or is it more or less consistent?
Let me take a first stab at it. I'll give you an example. The answer is there's great variability in the quality of data, right? And the fidelity of
Hmm.
that data.
Hmm.
If you take to its extreme modeling capabilities, an advanced natural catastrophe event modeling software platform can ingest hundreds of data points,
Hmm.
right? And some of the most sophisticated owners might have all those data points for every location. The truth is that most don't, and you might get a data set with 7 different artifacts that you can use for modeling. And that's not terrible, but not good. Some other owners get very sophisticated and have very granular data, which helps provide really good value for the modeling piece. And the point is well, how do we marry the two, right? How do we get let's call it a insufficient or let's call it not the best data set and improve it with what we have? And that's a big data science project of how do we accomplish that. And that I think there's intrinsically a ton of value in just that effort for 2 reasons. One, for our counterparties, right, on the capital side, they also struggle with a data question.
Hmm.
So if you become a repository of information, of validated, loyal, real information that they can base their own decisions on, that's really valuable for the transaction. And secondarily, the locations don't leave, they don't disappear. Some of them burn down, but most of them, let's call them move from ownership structures, right? Ani might sell it to TC, who might sell it to me, but the property still lives and exists. And then we're able to maintain a core group of information that allows us to become the de facto owner of, or like the source of truth of what's happened in that location. That becomes really, really valuable. Because, for example, if I buy the property from TC and TC bought it from you, I don't know what happened during your ownership period, right? While I might know what TC did with it, but we lose that, let's call it historic memory that allows us to inform our future decisions on it. I don't know, TC?
No, I think that's right. I mean, I think about the variability of data maybe across like two different vectors, right? You have the variability in the quantity of data that's provided. To Roberto's point, that depends on the client. Some clients have a relative paucity of data. Other clients have structured a very sophisticated data submission, right? And there's a big range between those. And then there's the other one, which is the variability of how they convey that data, right? Which is maybe more of a pure technology question. And I think so uh, that's we're still in the process of, I think, perfecting that part of our technology platform, really around the latter, right? I think like with the former, there are data science things that we can do, and there's other data sets that we can incorporate to build out a client's data from a relative paucity of data to something that the market would like to see. But from a technology perspective, this is where we're leaning into AI, for example, is to really open up the context windows of our data ingestion engine, right? So like we could recognize that is actually, these things are called 5 different things, but they actually are really just this one thing. So building some more flexibility and agility into our own platform.
Makes a ton of sense. In terms of workflows, going back to my consulting days of profit pools in various industries, and with so many intermediaries, it's sliced pretty thin. What's really powerful, what you're doing is you're helping clients accrue now a lot more value and disintermediating this entire value chain. If you could talk a little bit about even the granularity of tasks from the intermediaries that you're now replacing with software. I believe, you're not only disintermediating a broker, you're doing it with a risk consultant as well. You're providing actuarial support that a client never had. So if you could unpack that a little bit. I know we'd alluded to it earlier a bit, but I think a double click would be helpful.
I'll take a first shot at this one, Roberto, and then you come over the top. But the way that insurance, the value chain exists today, is there is a lot of information retrieval, repackaging, and conveyance, right? Like it's like we're the raw data stays the same. It's just that like every intermediary in the chain wants to see it a slightly different way, right? Before it's passed along. So when you think about, the client has all their operating data that has to be translated so that the retail broker can use it, right? And then what's the retail broker going to do? They're going to, package a bunch of clients. So they're going to take those clients to a wholesale broker, right? Because that's an efficient way for them to generate a sufficient volume of policies to a retail carrier who's going to want to see the data in a slightly different way. Well, the retail carrier is always buying reinsurance to lay off most of their tail risk exposure. And guess what? The reinsurer wants to see the data now in a different way. They want to see it in their own way. So when we think about, I think, a lot of the power of technology, it's really the ability to like create these transformations relatively easily and seamlessly, right? Like the raw data stays the same, but now you can interpret this raw data in the way that you need to interpret it for your use case relatively easily, right? I think like that is something that's very powerful about LLMs, and that's a lot of the workflows. Like obviously there are things like, claims administration and insurance. There's these things called certificates of insurance that you have to issue and track, and those one client could have 10,000 of those. And we have capabilities technologically to bring to bear on those things. But most of what we're doing is we are ingesting raw data, we are transforming that raw data, and then we're conveying that data in a manner that the counterparty needs to see it in order to transact. And I think like I think we have how can I say this? Our opportunity is that we have the opportunity to do that, right? We have the opportunity as an insurtech company to directly negotiate with every counterparty that really exists in any insurance transaction. And when you compare that to other insurtech approaches that are more focused on, I'm going to solve this workflow, right? So I'm going to solve policy ingestion, or I'm going to solve I'm going to make it easier to ingest loss claims, or I'm going to build a better module so clients can report losses, right? That's fine, but unless you're solving that for every constituency in the value chain, and they agree that you're solving it, and they're willing to give you value for having solved it, then in reality, you haven't created value, if that makes sense. So when a lot of insurtech approaches rely on 7 intermediaries all agreeing that yes, this works, and yes, we are going to give up value in order to adopt this approach. In our case, it's a little bit different for us, right? Because we are directly negotiating with those intermediaries in every transaction. basically.
Makes sense.
The one
Um,
thing, the one
Go
thing I
ahead,
would add
Roberto.
there, because I think this is kind of novel. If you think about the transaction currently, there's a very long lag between the client and the ultimate risk capital because he has to go through those intermediaries, right? From the client to the broker to the wholesaler to the retailer to the reinsurer and to the risk capital. It might be a year between when the
Hmm.
data is generated and the actual risk capital is consuming that data. It's dated, it's out of, it might be completely different now. We're also compressing the time the data is consumed, and therefore, that again, going back to fidelity on it, it's better data because it's closer to its source, not only of where it's generated, but also when it was generated. And that's where the tool really is going to shine, right? It's going to compress that timeline to consumption, right?
How are you using LLMs right now? Is it more in the bucket of data ingestion, parsing through general ledger codes, invoices, PCAs, as you alluded to, or is it something more on the on your platform that'll be more client facing and how they access information? How are you thinking about that?
It's going to be both.
Hmm.
From like a in the now and the near term, I'll call it. It's going to be mostly focused on data ingestion. So when we think about like what's core to our analysis, the ability to run actuarial models for our clients relatively quickly, that's a really hard deterministic problem that we feel like we've solved. Like until we need to incorporate new models, but it's not a use case that screams let's use LLMs, right? So like we've taken a fairly traditional approach to what I'll call the engine of our platform. Now, how do we get the data into that engine? I think is where LLMs are already providing a ton of efficiency, right? They're much more flexible. They have much larger context windows. They're much smarter than the types of approaches that we had even 3 to 4 years ago, and we're going to continue to push on that. So I mean, basically, they reduce the cost of taking on an additional data set dramatically, right? Which is in itself powerful because now the thing that that you may never get to or you're not going to prioritize for a couple of years until the business matures is kind of something that you can do right now, at least from like the data ingestion and database architecture perspective. So even if you're not going to build a feature that uses it for a while, the data is still going to be there in the correct architecture. So when you choose to build that feature, you could do it rather quickly. And with things like Claude Code, which we're starting to get into ourselves for more, let's call it like lightweight reports and feature development on the platform. Now we could potentially code these things in natural language too. I think obviously with the sophisticated stuff that's going to remain, that's going to be developed and using more traditional methods, still using AI, but like traditional engineering teams and traditional workflows and processes. Um, but I think like the really exciting element here is, no one's going to know probably on our team better than Roberto or I what we think a client might find valuable. And if we can spin that up in a relatively short amount of time, that's going to be pretty cool.
We've had the privilege at Symphony of partnering with you on this journey. You're obviously a company scaling with deep, deep domain expertise in the insurance space, actuarial science, but you choose to partner with an external R&D team to do the initial scaling, of course, with your internal capabilities. How did you think about, what you would keep in-house versus delegate, and any learnings from the partnership?
Uh, I could talk about sort of like our decision making matrix at the beginning. I mean, it was kind of like we had one of two paths we can go down, right? Like the one
Hmm.
very traditional path is find a founding engineer, very capable, right? Bring them on early. Likely has, I mean, I should reinforce the point that like Roberto is special. He's maybe one of 20 people in the world who transacts the way that he can with his level of sophistication. So even if you wanted to find, a senior engineer from the insurance space, you'd still have to teach them a lot about how our business works, right? And so we kind of fundamentally understood that at the outset. And so we looked at it and we said, all right, we could find this person, could be a good marriage, could be a bad marriage. Inevitably, they're going to have to hire a team, right, in order to develop this product. Or we could take, the agency approach. And I had the benefit of knowing Symphony going back over a decade. And we basically reached the conclusion that, all right, we know Symphony's incredibly capable. You can look at their roster of clients and just understand that very quickly. And we also have a very firm grasp of what we want to build. And the other choice that we made at the beginning was, a lot of startups will choose to be feature first because they need the technology to sell the product, right? We did not have to do that, which was a huge advantage that we had. So we could choose to develop the actuarial product first, right? And have faith in the fact that we could still sell, we could still earn revenue along the way, albeit with a suboptimal process, right? And I think that was a good choice because now we've built this, what is going to be a wonderful foundation for our ability to do a lot of really cool things very quickly, as opposed to launching features, having to figure out the back end down the road and fix it. So yeah, I mean, that was a little bit about the choice. And look, I think it's gone really well. I think we've come a long way in 6 or 7 months in terms of like findings or in terms of advice I would give. I think whether it's an internal team or an external team, there's always going to be a communication ramp up period, and there's always going to be an alignment on process. And in hindsight, could we have done it faster and more efficiently? Sure, we could have, right? So I think like for anybody looking to do this, what I would say is, the adage of measuring twice and cutting once is like as relevant here as anywhere else. And if you're looking to go down this path, and maybe in particular if you go down the agency path, because you do get to start with a fully built out team that can begin building immediately, is make sure you're spending the time at the outset to be sure that the thing that you're building is the thing that you want to build, and that you've communicated that in the level of granularity that's required to build it without any hiccups. I'm not sure that's avoidable ever, but that's advice that I would give.
If I can double click on two things there. One, my wife would disagree with the TC. She doesn't think I'm special. I'm just a guy that has worked hard. But anyways, no, on the communication piece, it's funny. We did a lot of due diligence in the process of hiring or partnering with Symphony, right? We talked to some competitors, we talked to some direct hires, and then we did our due diligence on talking to actual clients. And the feedback and the communication was clear. That was like, spend the time learning how to communicate with the engineering team, spend the time learning how to use Figma, learn the time how to properly articulate the vision into the engineers. And a complete neophyte, I'm not a tech guy, right? I'm an insurance person. I kind of put it in the bucket like, okay, like I'm a good communicator. To TC's point, measure 3 times. And spend the time learning how to communicate effectively, because it's not that there's any, that not necessarily delays the team. I think Symphony is very good at managing that, but learning how to communicate effectively lowers the stress level, if you will, from your side, which you're trying to do so many things, right? You're a startup, you're doing the tech piece, you're doing the business piece, you're doing all the business management piece. And if you're able to lower the temperature and the communication piece between you and the engineering team, that'll come back 1,000-fold, right? That's definitely worth time well spent. And yeah, it's been a good relationship thus far.
Wonderful. Yeah, it's 20 years, it's decades of experience from your brain and translating that into kind of an engineering team with specifically what you want. Yeah, it makes a ton of sense. Great.
Yeah, though sometimes it's I think the thing that's useful about taking a software engineering mindset is you do kind of have to like abstract everything, right? Which is not something that you typically have to do, particularly if you're experienced, right? Your brain just knows that you can skip 5 of these steps because, like, of course you can. And so, I think it's also forced us to be better, more abstract, sequential thinkers about everything about our business, right? Because now we can't rely on somebody, else to just like take that and understand it innately and execute it. We've got to provide that communication, but it also, I think, taking that sort of lens, taking that microscope to the process also helps you evaluate, okay, maybe this process shouldn't be the process either, right? Like maybe we could be more efficient. So it's been a very interesting journey. I think we've all learned a lot. Both us. We think of ourselves as one team, but the Artio side has learned a lot, and the Symphony side, they probably know more about insurance than they ever hoped to at this point.
Two final questions really for you. One, what's the future of Artio? I know we spoke about commercial real estate. What are the longer term ambitions, right? Because when we were prepping for this, there were talks of this could be applied to construction, transportation, marine insurance. Would love to hear both of your point of view there.
I'll take the first one on this one.
Mm-hmm.
I think the mechanisms and let's call it the theory behind how this works applies to any risk finance function. We focus on real estate because we have a particular affinity to it through our career experience, but the applicability goes broadly to anywhere you need to finance future losses. So the broader term is, as we develop our tools in commercial real estate, we'll have an opportunity to expand both horizontally, right? We're going to expand into other industry verticals, industrial, right? We're right now fully in multifamily. We'll do industrial, we'll do manufacturing and other asset classes. We'll also go into other industries. You already kind of telegraphed it: construction, aviation, marine, et cetera, right? Healthcare is a big one. Public entity is a big one that will have similar needs to what commercial real estate does. And then we'll also have an opportunity to expand vertically. Right now, we're in the middle of the transaction and that translation later, right? We're taking the client's need, translate it into what the capital needs are. But there's also vertical integration where we can actually be higher up in the stack. We can also translate this to the fronting carrier and other relationships that we're right now just relying on third parties for. And maybe ultimately there's some risk taking at the end, right? Maybe Artio becomes a risk taker to the transaction, right? So I think from my perspective, that's where it's probably heading to,
I agree with all that. And I think that's like sort of, I think a lot of areas the company is going and will go and could go. My slightly different response to it would be, where is Artio going, like relative to where it is today? When you think about buying, like a SaaS product, or you think about buying a phone, right? Like you don't go to you think about buying a phone, you don't go to the Apple store or wherever, AT&T or wherever, and they don't tell you the components of the phone. They're just like, do you want this phone? And this is how much it costs, right? Because you know what a phone is and you know how to value that phone. In insurance, it doesn't work that way. They say, okay, you're in commercial real estate. Well, in order for you to have any ability to understand the thing that you're buying, we're going to speak to you in an entirely different language, right? So like, none of the language that we're going to use to sell you insurance is the language that you would use to operate your business, right? Like retentions and deductibles and mud maps and like towers. And I can go on this topic.
Acronyms, SIR, DA.
At the end of the day, it's all finance.
Yeah.
Right. So it's all math. And so it's really just a choice of how you want to convey the information. And I think, generally, like maybe like one thematic way Artio is going to evolve is going to basically be able to translate the mechanics of insurance into the language that the client's business operates in, right? Which I think it will be a lot easier for people to understand the potential here and the opportunities. And frankly, that is what we see with every client engagement that gets a certain way. It's like for the first couple of meetings, man, this is hard and sophisticated and weird. I've never thought about it that way. When it clicks that insurance is very similar to any other debt product, they're like, oh, okay, right? Like now I can think about it as part of my capital stack, and I'm a really good capital structure, right? And so it's like a light bulb that goes off, and I think we have an opportunity to improve further how we do that through the technology.
Final question for both of you. For founders that are of the similar archetype, right? Folks who've seen an industry, legacy, regulated, complex, entrenched players over many years. You're seeing friction, you're seeing pain points, you're starting on a journey of building your company because you see clear opportunities to disintermediate spaces. Any overarching advice, any lessons learned, especially when there's so many entrenched players and things have been done a certain way for many years, there's an education component of it, but you see all this opportunity with technology on what you've learned from your journey so far.
Do you want me to go first, Roberto?
Go for it, TC. I'm older, so I have a little different perspective.
I would say, I grew up in Silicon Valley, right? So I grew up in Menlo Park. My dad was an entrepreneur. He was in hardware in the semiconductor industry, so a bit different. But like, I grew up in Silicon Valley. I went to, college in the Bay Area. I lived in the Bay Area most of my life, and I was investing in, technology companies for most of that time. Silicon Valley is fantastic at a lot of things. But I think one muscle that Silicon Valley is not very good at is related to your question, which is, I call it sort of like the field of dreams approach to company building. Like if I build it, they will come. And for some things that works. Like if you build a great consumer app, consumers will flock to that app. And I think, for industries that are used to buying technology, it's easy for them to immediately grasp how valuable is that technology and how am I going to implement that technology to create value for myself. Whether it's real estate or insurance or, pick industry that has not been, really impacted by technology or software, I think they all share one common theme, which is there are a lot of stakeholders in these transactions who all need to be spoken to, right? And there's a lot of steps and there's a lot of workflows, and you cannot elide a single one when you're looking to, in my view, successfully scale into one of those industries. You have to have an accounting for each of those questions. It's not like, oh, I'll figure it out later, because that unanswered question could be the grenade that blows up your entire business. And so, I think as Roberto and I think about and have thought about Artio, there are easy things and there are hard things, and there will continue to be hard things. But as long as we have answers to all of those hard questions, right? Reasonable answers, then they're, getting past them is achievable, right? But you have to I think it's incumbent on the entrepreneur in these types of industries to think really long and hard. Do I have answers to all of these questions before I get started, right?
From my perspective, I agree with TC. From my perspective, there is the best piece of advice I can give somebody that's starting this journey, right? And from the perspective you said, right? Entrenched business experience, regulated, difficult task, is that you as an entrepreneur have this goal or this vision or this guiding principle that is leading you down a path. And that sometimes competes with your client's needs, because a client is used to transacting in a certain way, right? Or a client is used to doing things in a very similar manner. And you're asking them to move away from that, call it comfortable place where they've been doing business a certain way. And while you're while your vision can be true and correct and ultimately what will prevail, I think that you always have to keep in mind how what you're doing is going to be accepted or performed on by your client, and being able to have less than perfection. You need to be comfortable with achieving a version of your goal that's less than perfect, right? Like maybe that the ultimate goal would be perfect, but right now you're going to have to live and be successful with a lesser version, right? And I think that's challenging for people that, like if you take TC and me, right? I'm 51 years old. I've been doing this for a long time, and I know how it should be done, at least from my perspective. But the actual product is going to be different because the market is going to react differently. You're going to have to shape it differently, and it's not going to be the version you started off with. And you have to be okay with that. You have to be okay with like that uncertainty that we're going to arrive at a place that's going to be different than what you set off for, but you're going to be okay with ultimately creating this new thing, right? I joke with TC, we have like, it's a teacup, right? A tea candle, right? We had to protect this tea candle. There's this dream here to create like a big fire around it. And you're going to protect it while you're going down this path. And not to get discouraged by those moves, right? You have to be nimble on it. Communicate and be nimble, right? Those are the two words I would say.
Be water, my friend.
Yeah, 100%. Yeah.
TC Roberto, this was wonderful. Thank you for distilling something that was so complex down, for being so generous with your time. Both of you are on a very, very exciting journey. Congrats on your success so far, and waiting with bated breath to see future versions of Artio and the amazing company both of you are continuing to build out. Thanks again, and really enjoyed having you on this podcast.
Thanks, Ani.
Thanks for having us on. This is great.